The Roth IRA is one of the best retirement vehicles ever created. And for those of us planning to retire early, it's even more appealing. While I've been one of the biggest advocates for the Roth IRA, I recently discovered I was overlooking another powerful early retirement account. And it wasn't until I started planning our withdrawal strategies that I noticed the significant blind spot. My latest research suggests there might be an even better place to invest your money for early retirement. While it's not superior in every situation, it offers major advantages that I'll cover in this video. I'll review the key benefits for the Roth IRA, I'll introduce you to this alternative investment account, and I'll show you how it stands up against what's arguably the most beloved investment vehicle in personal finance. Then you can decide if the advantages tip the scale for your situation. Let's explore the 6 major benefits of the Roth IRA, which we'll use to compare with our alternative option. The first benefit is tax-free withdrawals. In a traditional pre-tax 401k, your contributions lower your taxable income for the year that you're making a contribution. However, you'll pay taxes when you withdraw the funds in retirement. A Roth IRA works differently. You pay taxes on your contributions up front, but all of the future withdrawals are tax-free. Whether you withdraw $100,000 or $1 million in retirement, you won't owe any taxes. The second benefit is tax-free growth. Along with tax-free withdrawals, you won't pay taxes on any investment growth as long as you use the funds in retirement. Here's an example. If you invest $7,000 today in your Roth IRA, which is the 2025 contribution limit, and it grows 7% for 40 years, that one contribution will turn into $104,000, all tax-free. While you pay taxes on the initial contribution, all of that growth is yours to keep. The third benefit is tax diversification. Because of the tax-free withdrawals, Roth contributions serve as an excellent hedge against future tax increases. If tax rates increase, you've already paid your taxes for your Roth investments and won't be required to pay taxes in the future. Most experts recommend having some tax diversification, meaning both pre-tax and Roth investments. This gives you more flexibility to manage your taxes in retirement because you can pull from either bucket as needed. But the tax benefits aren't the only reason investors love the Roth IRA. The next benefit for the Roth IRA is access to contributions. Since you've already paid taxes on your contributions, you can access this money at any time. Need funds for an unexpected emergency? You can tap into your contributions without penalty. Note that this only applies to contributions. While you'll have penalty-free access to growth and gains in retirement, before age 59.5, contributions are the only thing you can touch penalty-free. Now, it's this flexibility that makes the Roth IRA particularly appealing. You can invest for retirement while also maintaining access to your contributions if you really need to. Another key benefit is that the Roth IRA has no required minimum distributions or RMDs. Unlike a traditional IRA or 401k, which require you to start withdrawing funds at age 73, Roth IRAs have no such requirements. With traditional accounts, you will have to withdraw a certain amount based on your balance and life expectancy. Now, large balances in your pre-tax accounts can push you into higher tax brackets. This limits your ability to minimize your taxes or to qualify for benefits like the premium tax credit or the ACA subsidies. With no RMDs, Roth IRA funds can keep growing as long as you want. You're never forced to withdraw them. Finally, Roth IRAs offer a wide range of investment options: stocks, bonds, mutual funds, and ETFs. This ultimately lets you build a portfolio that matches your goals and invest in low-cost index funds that might not be available in other retirement accounts. Employer-sponsored plans like 401ks typically offer limited options due to administrative costs, regulatory requirements, and employee behavior considerations. Now, this is by no means an exhaustive list. The Roth IRA has even more benefits, but these are the most significant ones that make it such a popular investment vehicle. But it's not the only option worth considering. In fact, I believe the taxable brokerage account, which everyone can access, is just as good, if not better, for most early retirees. To explain why, let me first break down how long-term capital gains are taxed in the US. If you're already familiar with this concept, feel free to skip ahead. I'll add a timestamp up here just to show you where to jump to on our side-by-side comparison. Let's start with the basics of how long-term capital gains are taxed. A long-term capital gain is profit earned when selling an investment or an asset you've held for more than 1 year. Simply put, it's the selling price of your stock minus what you originally paid for it, or your basis. Long-term capital gains get special tax treatment compared to short-term gains or ordinary income. Your long-term capital gains tax is based on your total taxable income, which includes ordinary income, capital gains, other income, minus deductions. So here's some context. The US uses a progressive tax system with marginal tax rates for ordinary income of 10%, 12%, 22%, 24%, 32%, 35%, and 37%. Long-term capital gains have their own favorable tax rates, 0%, 15%, and 20%. I'm displaying these rates and their income thresholds on the screen here. Most US households pay either 0% or 15% on long-term capital gains, with the rate determined by taxable income. Early retirees in particular can often manage their taxable income to stay in the 0% bracket for long-term capital gains. And for married couples filing jointly in 2024, you can have taxable income up to $94,050 and pay no long-term capital gains tax. Add the standard deduction of $29,200 and your total gross income could be $123,250. In 2025, this increases to $126,700 with adjustments to both capital gains thresholds and the standard deduction. Now let's walk through a practical example to illustrate how this might work. A married couple earns $60,000 in W-2 income in 2024. They could realize an additional $63,250 in long-term capital gains and pay $0 on those gains. They'll still owe taxes on their ordinary income of $30,800 after the standard deduction is reduced, paying $3,232 in federal taxes under the progressive system. This matters because by carefully managing your taxable account in early retirement, a taxable brokerage account can provide tax advantages similar to a Roth IRA in most situations. Plus, a taxable brokerage account offers some advantages in comparison to the Roth IRA. Now that we understand how long-term capital gains are taxed, let's compare the Roth IRA and taxable brokerage account side by side. We'll examine the same categories that we use for the Roth IRA benefits, plus a few additional ones for a complete comparison. So like the Roth IRA, a taxable brokerage account can provide tax-free withdrawals if you maintain an income of less than approximately $126,000, something that's quite manageable for early retirees. Both accounts offer tax-free growth, but with two key differences. The first difference is while a Roth IRA allows you to withdraw $1 million completely tax-free, as I mentioned earlier, withdrawing that amount from a taxable brokerage account would push you into the 20% long-term capital gains tax bracket. The other consideration is dividends in your taxable brokerage account. This counts towards your gross income, but as long as they're qualified dividends, it is taxed with a favorable long-term capital gains tax bracket. In full disclosure, I'm glossing over some important details around dividends, especially what makes them qualified dividends, but this video is already a long video. You can either research this yourself or wait for a future video where I dive into how dividends affects your tax planning. Suffice it to say that the taxable brokerage account is not as good for tax-free growth, but most of your growth can be tax-free. Now the next category is tax diversification. While the Roth IRA is known for tax diversification, the taxable brokerage account provides similar flexibility. You can withdraw from different buckets, pre-tax and taxable, just as you would Roth and pre-tax accounts. You'll pay taxes on withdrawals from pre-tax accounts as if they were salaried income, while the taxable account only requires taxes on the gains. And remember, those taxes on gains only apply if your total income exceeds the threshold that I mentioned earlier. And having all three buckets is the ultimate strategy for maximum retirement flexibility. Now, the next category is access to contributions and growth. The Roth IRA restricts access to growth until age 59, with early withdrawals incurring a 10% penalty, though contributions are always accessible, as I mentioned earlier. A taxable brokerage account has no age restrictions. You can access both contributions and growth anytime. While selling off investments in your taxable brokerage account will have tax implications, you can time them for tax advantages or when you need the funds. For example, my wife and I recently purchased a home in New Hampshire. We sold off about $50,000 of investments from our taxable brokerage account to buy the home outright. Since our income was low enough, we paid zero taxes on about $20,000 of long-term capital gains. Now, the next category is no RMDs. Neither account requires minimum distributions. Since both are funded with after-tax dollars, you'll never be forced to sell investments or make withdrawals. Now, the next category is investment flexibility. Like the Roth IRA, a taxable brokerage account offers unlimited investment options, letting you customize your portfolio and maintain low expenses. Now, the next category is contribution limits. The Roth IRA caps contributions at $7,000 per person and has income limits. In 2025, singles are phased out between $150,000 and $165,000, while married couples filing jointly phase out between $236,000 and $246,000. Taxable brokerage accounts have no contribution or income limits. You can invest as much as you want, regardless of income. Now, the next category is impact to beneficiaries. Both accounts offer valuable benefits to their heirs. For Roth IRAs, the rules differ between spouse and non-spouse beneficiaries. Spouses can treat it as their own or roll it into their Roth IRA, avoiding RMDs. Non-spouse beneficiaries must distribute the inherited IRA within 10 years and take RMDs. Now, taxable brokerage accounts treats all beneficiaries equally by offering what's called a step-up in cost basis to the fair market value at the time of death. This means the investment's cost basis or purchase price resets to the value on the date of the death. Since capital gains are calculated as the difference between the sale price and the purchase price, this step up significantly reduces taxes for heirs. Beneficiaries can sell inherited investments in a taxable brokerage account immediately without owing any taxes, as the sale price essentially equals the stepped up purchase price. And to sweeten the deal, unlike the Roth IRA, there's no 10-year distribution requirement. The Roth IRA has a slight advantage since beneficiaries can grow part of the inheritance tax-free for another decade, but both accounts treat heirs favorably. When you consider everything, the taxable brokerage account becomes incredibly attractive to early retirees. If you can keep your taxable income under $120,000 annually, it offers exceptional tax advantages while maintaining superior flexibility. And here's the even better news. Most households don't have to choose between the Roth IRA or the taxable brokerage account. They can use both. Now, I can already anticipate the comments below, so let me be crystal clear. My point is not to dismiss the Roth IRA. Rather, I recommend using both accounts while recognizing how valuable a taxable brokerage account can be in your early retirement strategy. You might think a taxable brokerage account is completely unnecessary since there are ways to access pre-tax funds before age 59 and a half. But these strategies overlook some key considerations. I go into more detail in this video right here. As always, thanks so much for watching and enjoy the journey.